I welcome all the participants who have joined us for this interactive webinar session where we'll be discussing what are the various financial tools that are available for MSMEs and how MSMEs can decide among these tools so as to improve and like grow their financial health. And this webinar is jointly organized by Power to SME and Care Edge, who have joined us as the knowledge partner. So before I request Dr. Kumar to take this session forward, I would just like to quickly walk you through the profile of the organizers, that is Power to SME. And we have Mr. Akajan from Care to speak about this organization. So Power to SME, it was established in year 2012 by our founder and CEO, Mr. R. Narayan. He came up with a very innovative business idea which eliminated the intermediaries in the supply chain of commonly used raw materials from the big manufacturers to the MSME manufacturers. And we tried to do that on a demand aggregation model, and thus we were able to provide better pricing to the MSME manufacturers. And just to add here, Mr. R. Narayan, he is also the current president of FICCI CMSME, which is the MSME body within FICCI. And this is the entire Power to SME ecosystem. Power to SME deals in raw material procurement and sourcing business. Our branch FinanceMe, it connects MSMEs with the empaneled financial institution for the seamless approval of working capital loans. Our brand SME Shops is the India's biggest B2B portal for MRO and industrial consumables. We also have our NBFC with the brand name of Wiz Funds, which offers very innovative and contemporary financial solutions in raw material procurement finance. These are the key product categories that Power to SME deals in: steel, polymer, yarn, chemicals, and there are several others. The major industrial sectors that we cater to include automobile, auto components, infrastructure, textile, electronics, and many more. Power to SME is a one-stop solution for all the needs of a manufacturing MSMEs, right from their raw material procurement at a competitive prices to the raw material purchase financing. So we provide end-to-end solutions within this space. We are an invested company. Some of the most reputed venture funds in the country have invested in us. Inventors, Kalari, Excel, and Nandan Nilekani is one of our strategic investors. We are also funded by World Bank through its financial arm, International Finance Corporation. These are the few awards and accolades that we have won since our inception. And this is where you can find us. Any one of you wanted to know more about our service or need to connect with us can reach out to us through any of these media. So with these words, I would now request Dr. Ishti Kumar to kindly take over the session. And if any of the participants have any query or question to be asked to our speakers, kindly submit your questions in the Q&A in the chat box, and these questions will be taken to our panel in the Q&A session. So over to you, Dr. Kumar.
Thank you, Mr. Zumair. Thank you very much. Am I audible clearly?
Yes, sir.
Okay, thank you. Thank you very much. In fact, my greetings to all the distinguished panelists and the participants. The issue of discussion today, in fact, how to decide right financial tools for improving the MSME's financial health. In fact, when I read this subject, I got reminded of my, days when I used to study. We used to decide about the financial tools to improve the financial health of businesses. I mean, in some of our, college work. So I got reminded of all the ratios and the financial parameters which are really required for improving the financial health of MSMEs. And at the same time, I also, remembered that over the last 20 years that I got associated with financing through my corporation NSIC and the rating mechanism, I've seen that thousands and thousands of applicant borrowers, particularly the micro enterprises and smaller enterprises, the smaller ones, have been facing a lot of problems in projecting their financials and presenting their financial condition, financial position to the banks and financing institutions for availing the credit facilities. There is a mismatch in the expectations of the bankers and financing institutions and the applicant borrowers. Now, bankers expect a very standardized kind of financial health in any business enterprise. It has to be viability. It has to be financially parameters should be strong. The repayment capacity, starting from the viability with break-even analysis and all those financial ratios. Uh, they are attuned to accepting and seeing to these parameters. It doesn't take much time, in fact, for them to analyze the balance sheet or the financial condition or the financial projections. In 10 minutes time, they will let you know whether you are financially healthy or not. But the applicant borrowers, the MSMEs particularly, when they keep struggling in preparing their financial position, application forms, and attaching their financial statements, they don't know really as to what is wrong with their financial condition, why their proposal is not being considered, and why the bankers are seeking more and more information, and at some point of time saying that your project is not viable. They keep getting the help of financial consultants, chartered accountants in preparing the financial projections also. But somewhere across the line, they don't know, in fact, what is wrong and how do they really prepare their financial position and present their financial health or the financial projections which satisfies the bankers' expectations. So here lies the importance of this subject that we are going to discuss today. uh, I will invite the guest speakers, in fact, who are very experts in these issues. Mr. Akash Jain, who is the Director of Care Ratings Limited, and the other expert, Mr. Yashish Asher, who is the partner of Bhuta Shah and Company LLP. So they will surely, from their expertise, they will surely let us know as to what are the financial parameters, how do we project our financial condition, and what are the key elements which are really important for any business enterprise, more so for micro small enterprise, to project before the bankers while making any loan application, and what are the important parameters which bankers have to look at. So before I invite the guest speakers, in fact, I have few inputs to discuss, to mention, which I remember from my old days, of course, and the studies that we have undertaken with regard to our financial management curriculum. So the tools that we can use is basically in terms of the ratios that any balance sheet or any financial statements would surely throw away to look at. Now, what are those important tools? What are those important ratios that are important, in fact, and they really bring out the real position, financial position also from the financial statements of any company. So first thing is basically the leveraging, as to how much is the equity and debt in a company, and whether there is a matching of the long-term debt to the long-term assets, and current assets being financed out of the current liabilities. Matching, of course, is important because to see that you have not diverted your current resources for funding your long-term assets, and vis-a-vis the other side also. So that becomes important. The debt equity ratio, as we know, the bankers look at not more than 2, but in some cases it can go up to 3. I mean, if your equity is 1, your debt should not be more than 2 in ideally. But then in many business enterprises which are infrastructure, high capital intensive enterprises, it can go up to even 3 also, 3 or 4. For NBFCs, the Reserve Bank of India has permitted even much higher ratio of 6. I think it is 6, if I'm not wrong. So leveraging is very important. And second thing is the liquidity ratios, which is debt equity ratio, of course, current ratio. Your current assets should always be financed out of, partly out of long-term resources and partly out of current liabilities. Your current liabilities should not be more than the current liabilities under any current assets under any circumstances. There has to be an ideal ratio of, I would say, 2:1, but more the merrier. But in any case, not less than one. I mean, your current assets and current liabilities should not be less than one. Current assets have always to be more than one, so that the ratio is sound and you should be able to meet. The objective is that you should be able to meet your current liabilities out of your current assets, because you can't sell your fixed assets for meeting your current liabilities. So that is a liquidity ratio, which I remember is a very important tool for measuring the financial condition or the liquidity condition of any business enterprise. There are finer, liquidity ratios also, like quick ratio. I am not going into the details of all those, but by and large, we have to see that the liquidity is maintained, and the financial condition with regard to availability of resources is comfortable. And third, of course, is the profitability. The ratios of profitability are very important, because your business has to show that the business is viable. Starting from break even, then your return on equity and return on investment both become very important. The profitability ratio also includes in terms of net profit to turnover ratio, because if you are having large turnover, I mean, I am not saying there is a standard ratio, because in large trading enterprises the ratio will be much less, but in certain manufacturing enterprises the profit to turnover ratio will be substantially higher. And in service enterprises, we have seen that the profitability ratio, profit to turnover or profit to revenue ratio, is much, much higher. It could be even more than 20, 25, 30% also. And that is how the taxation regime also has been, devised. So then there are certain other ratios, receivables, the age of receivables and inventory turnover ratio and asset turnover ratio. All these ratios basically indicate your financial health, and bankers are interested in, and they would analyze all these ratios. I mean, having seen from all sides whether your liquidity is strong, your capital gearing is good, and your profitability is nice, and then that is the existing situation. Then they go for the financial projections. Future, what is the future? Whether the future is also tending to be in line with your existing financial position, whether you are improving in terms of your revenue generation and profitability improvement. I mean, what is the reason that your turnover is increasing and your profitability is not increasing? So all these parameters they have to look at. I mean, I can understand it's a very complicated kind of a thing, but once you understand, once you are used to knowing the expectations of the banker, and you know how to analyze your balance sheets and profit and loss account, and accordingly you can prepare the financial projections, then of course it is easier for you to deal with the bankers. So having said that, I think there are many other issues. Rating becomes very important in taking a decision, but of course we have a friend from rating agency, Mr. Jain, who will be able to tell us as to how rating is playing an important role in bankers' minds, and how far it is compulsory, in fact, for business enterprises to go for rating. And then I would also request him to mention as to, there is another kind of rating which has come up now. All these rating agencies have started, is probably that is called credit grading. I think it's credit grading or credit scoring, something for MSME sector, probably a new paradigm has started. So the difference between credit grading and credit rating, also we would like to know as to who should go for grading and who should go for rating, and how this difference can be, understood. That is also another important parameter that we would like to understand. And lastly, Mr. Rashish Asher probably would be able to tell us, being a practical person, in fact, he must have dealt with hundreds and thousands of business enterprises financials, as to what are the key elements which a business enterprise particularly should take into consideration while moving any loan proposal. Or I would say, why only loan proposal? Because you may be dealing with a foreign buyer, you may be dealing with a supplier, you may be dealing with a large corporate for any other purpose, and or you may be filing a tender of the government or any other work, who would surely like to look at your financial position and your financial strength. So how do you project your financial position? How do you project your financial strength? What are the key elements that you should be able to project out of your financial position, which really shows that you are financially strong? So, having said this, I would like to invite my first panelist, Mr. Jain, Akash Jain, who is the Director of Care Ratings Limited, and his domain is corporate ratings, SME ratings, and grading. Yeah, that's what I was mentioning, rating and grading. As the head of CARE's business development in rest of Maharashtra and Goa, he is responsible for providing tactical impetus to CARE's business. He was earlier heading South India business, SMEs and corporate ratings for CARE ratings. He also looks after strategic tie-ups and initiatives of CARE rating. So over to you, Mr. Jain. I think you very well know as to what we are talking about. So we would like to have your expert views.
Thank you, Dr. Kumar, for such a kind word and introduction. Good evening, everyone. So yeah, I mean, I'll try to give an overview first on the overall MSME sector, and then probably I'll jump on the credit and as Dr. Kumar mentioned about the debt and equity mix, the requirement. I will try to go a little deeper on that and try to mention the addressable credit gap in the sector. And then probably I'll jump on to how a rating agency like us can play an important role and can bridge the overall gap, which is currently, very, very strongly and prominent point, which we are all trying to ascertain and trying to manage that particular gap. So I'll try to jump on
Sure.
that last.
Yeah, please go ahead. Yes.
So yeah, MSME, as we all know, we have 55.8, roughly around 60 million MSMEs within the country. The GDP contribution from the MSME sector, as we all know, is closer to 31%, and 45% of the overall exports derive from MSME sector. But surprisingly, I mean, out of 55.8 million, what we have been talking the MSME numbers, only 8.2 million MSMEs are registered. So this is the one big gap. I mean, this is the basic. I mean, probably we have to look on this number and try to ascertain, I mean, how we can start from the scratch and try to build, a system wherein most of the MSMEs come on a formal platform, wherein most of it are registered and the data, transparency are widely available within these stakeholders. Having said that, now if you will analyze the sector, we have a very limited because of the small ticket size, small ticket size of loans, higher cost of screening the segment, the appraisal, and the limited ability of MSMEs to provide the immovable collateral. So collateral, I mean, MSME lending, what we generally are talking about is a collateral based lending. It has never been a cash flow based lending. Cash flow has been, of course, a part of it. But again, the collateral, immovable collateral requirement is immensely very high when we are all talking about the lending within the MSME sector. If you look at the demand for both, as Dr. Kumar mentioned about the debt and equity, it is expected to closer around 88 trillion INR, out of which the debt requirement would be roughly around 69-70 trillion, and the remaining would be the equity mix. Probably if I talk about the 69 trillion of the debt requirement, only 11 trillion out of which are being funded through the formal sources. And when I say the formal sources, it is all our financial institution, it is the banks, it is the NBFCs, who are actually doing the funding to this particular sector from the formal sources. And the remaining, the major part of it comes from the informal sources. Now, if I'll talk about the addressable credit gap, which is there in this particular sector, it is expected to be around 25-26 trillion, which is immensely very, very high. Even after such an introduction of various schemes by the government in the past. I mean, we have still been seeing a great gap in terms of the overall credit requirement versus the supply. I will be also be willing to talk about the enablers which actually are helping the MSME ecosystem, MSME financial ecosystem to grow. I mean, to get the growth in terms of their financing requirement. So there are precisely three pillars which we can all analyze. One is the legal and regulatory framework. Second would be the direct government support, and third would be the infrastructure support. When we are all talking about the regulatory framework, precisely it is all MSME Bill 2015, SARFAESI Act 2002, the PSL lending. Then we can also talk about the regulation of Factor Bill 2011, and Company Act, Insolvency and Bankruptcy Code. When we are talking about the government support, it is all subsidy-based support, public procurement policies, the credit guarantee schemes, and the last pillar would be the infrastructure support, which is precisely the support from the credit information companies, rating agencies like us, collateral registry, asset reconstruction company for SMEs, and the trades. Now, this is very, very interesting. I mean, I'll be I'll be willing to talk about my domain, which is precisely the rating agency, how a rating agency like us can play an important role within the framework and the system to enable MSME grow to the next level. So when I say that, I mean MSME rating agencies like us plays like an catalyst between the MSME borrowers and the financial institution. When we rate any company, we try to assess the credit worthiness of a borrower to repay the debt on time. When we assess any sort of companies or MSMEs, we take into consideration the last 3 to 5 years of the financials, the financial performance, and next 3 to 5 years of the futuristic projection. That helps us in assessing the quantitative parameter, and we also factor in the qualitative parameter. I mean, when we do the assessment for any MSMEs, which also plays a very, very vital role to arrive at any sort of conclusion as far as the rating outcome is concerned. Now, there are various initiatives, have been taken by the government in the past in terms of, providing the financial proper finance, adequate finance during the COVID period. So we have seen a lot of ECLGS scheme, the credit guarantee scheme, which has been announced by the government to enable MSMEs. Businesses should not halt and come at a standstill. So that has definitely helped the sector to revive to a certain level. But still, I mean, I would say that there is a lot need to be done. With the expertise of Dr. Kumar and all others in the ecosystem, I'm sure in the time to come, things will play a very, very, wider change. And I'm quite hopeful about it. To conclude and to add a point on it, I mean, as what Dr. Kumar has asked me to speak on, which is rating and the grading. So, I mean, in the past, I mean, there used to be, SME ratings, which, we used to do. Now, that subsidy-based ratings, what we were earlier doing, it is no more available in the market because the subsidy and all is stopped. So currently, I mean, what we do currently for MSMEs are precisely the bank loan ratings. It helps the client, it helps the MSMEs to go to the bank with the rating and try to ascertain that the timelines or the rates, whatever the banks are offering post getting rated by us, if the rating comes well, it helps them to negotiate it better, and the turnaround time also from the banking side, it gets reduced. Another point I would also like to mention is rating also helps any MSME or any corporate to reduce the information asymmetry. Information asymmetry is a very, very bigger challenge and a big problem as far as the any credit appraisal is concerned. So Mr. Kumar also has mentioned about it, that the expectation from a client, MSME, and expectation from a banker, there is a mismatch. And the mismatch is because the data what generally it comes on the table of MSMEs by SMEs to the bankers. There is a wide amount of dispersion, and that's the point which we are trying to ascertain from being a rating agency, that that particular problem should get minimized, and we are working on that. And I'm sure in the time to come, I mean, we have many MSMEs coming to a rating agency and getting themselves rated, and things will move to the next level. So yeah, this is at this point of time, this is from my side. I mean, lastly, I mean, it also may be noted that when we analyze or rate any company, we try to showcase the mirror image of how they are actually performing, or you can say that it's like a health checkup of any sort of MSME, what we are currently rating. We try to give them how fit or unfit they are and what are the areas of improvement. Thank you so much. Over to you, Dr. Kumar.
Yeah, thank you, Mr. Jain. Thank you very much. It was a very informative talk. In fact, with regard to the rating mechanism that you mentioned, the bank loan rating, of course, has been in vogue for a long time. But then the grading, which has just started, the bank, this credit grading, I was trying to understand as to what is the validity of this grading and whether the banks are accepting this grading. And if the grading is acceptable, then why should the banks, the customers or the MSMEs go for rating? So this clarity is required. In fact, if you can
So
clarify this.
I would just like to mention that, as you are aware, I mean, a while back, say back in 2012-13, we used to have the NSIC MSc performance credit rating scheme, wherein we used to do the rating for any MSME under NSIC framework. In that particularly, I mean, the 75% of the amount was being subsidized by the central government, and the remaining was being paid by the rating, by the client. Now, just to give you an overview, I mean, the SME grading is precisely the replica of the SME ratings what we used to do earlier. And now, because as a rating agency, we are not allowed to do any sort of non-regulated, services. We cannot offer any non-regulated services. So all of the rating agencies like us, they have this subsidiary or the advisory arm, wherein we are carrying out the SME gradings and various other services for SMEs, like due diligence services and the credit score for SMEs, which we are trying to introduce, so that the practice of getting assessed should start from a very beginning, for MSMEs. And once they move it to the level where the bank loan rating is essential, when it becomes a mandatory, so at that time they can directly graduate to it to the next level, rather than just coming up for the first time and getting themselves rated under bank loan rating scheme. So that way, I mean, it's like moving from grading and moving to the rating level as and when required.
So maybe that is the reason that the government has stopped the subsidy, because once you shift MSME rating to MSME grading, which is not acceptable by the banks, or they don't get any benefit. So if they don't get any benefit out of grading, then why government should pay subsidy for that? So it is harmful for both, for rating agencies also, as well as for MSMEs also, and for banks also. See, banks were getting rating reports with a very small amount being spent by the MSMEs,
Correct.
or the applicant borrower.
Correct.
And they were getting a third party assessment and opinion, and banks were also getting the benefit.
Sure.
So I don't know really who is benefiting from this grading business, because this is not consultancy.
I mean, just to give you cracks, I mean, when we used to assess any MSME, we used to give a kind of a 30-40 page report, kind of a detailed performance report with a rating attached to it. So it is like what the SWOT analysis and peer comparison, and overview of industry. It comes on a proper template, proper format. So whenever that report goes to the bank with the other documentary requirement for financing, it helps the banker to understand and gives additional cushion to him for doing any credit appraisal for MSMEs.
Yeah, that's what I was saying, that the MSME scheme, rating scheme, was helping the MSMEs as well as the banks.
Absolutely.
And rating agencies also were getting a lot of business by virtue of lakhs and thousands and thousands of new MSME customers coming for rating.
Yes.
So by shifting that rating to grading and then making them out of the ambit of the bank loan rating. So I don't know who has benefited, because the government stopped the subsidy.
So
And customers started. What is the purpose of that? Really, I can't appreciate. Anyway, maybe that is a different issue to discuss at a later stage, because we have been requesting the government to restart the rating subsidy. So this issue is important, in fact, that MSME rating should be acceptable by the banks and should be recognized by the Reserve Bank of India. Then only they will go for rating.
So I can just give you one overview and one pointer on this. There are a couple of PSU banks who have made it, kind of a mandatory or kind of a documentary requirement for all the MSME proposals to get themselves stated by a rating agency under SME rating scale sometime back. And any proposal where the requirement was above 5 crores to the extent of 25 crores, where the bank loan rating was not mandatory, SME rating has came into the play.
Okay.
Yeah.
Okay, some way or the other, you mean to say the grading also is relevant. In fact, it's not completely that it's not being accepted.
It was ultimately helping the banker to assess and bridge that information asymmetry gap which was there,
right,
which is there.
Right. So let me bring in the other expert panel member of the panel is Mr. Yashish Asher, who is partner in Bhutasha and Company Private Limited LLP, and since March 2021, and is an integral part of the tax and regulatory regime. Mr. Yashish has over 13 years of tax and regulatory experience, as well as in merger and acquisitions, group restructuring, inbound and outbound investment structuring, transaction structuring, due diligence, fund and structuring, tax modeling and negotiations, wealth and estate. Oh, long list of his expertise. Prior to this, he was a part of various big four firms, PwC and EY. Yashish has authored and co-authored various articles on tax, regulatory and transaction aspects, and is a TIE charter member and also strategic advisor with MSME Business Forum. So over to you, Mr. Asher, for your inputs. You are on mute, Mr. Asher, if you can unmute yourself.
Yeah, thanks a lot, sir, for the kind introduction. Good evening, all the audiences and my fellow panelists. My topic for this particular session is in relation to how an SME can optimize the financial options which are available to it, within the given framework. I'll just share a small presentation deck which I have, okay, for everybody's benefit. Okay, so herein the financial options which are available to MSMEs under the domestic situation is basically covered within the framework of say share capital, mezzanine, and debt financing. In case of share capital, obviously we have equity shares, we have instruments in relation to redeemable preference shares, which can be issued by a company, compulsorily convertible preference shares, and OCRPS, which is optionally convertible preference shares. In case of mezzanine financing, obviously the company can issue CCDs, which are compulsorily convertible debentures, and optionally non-convertible debentures. Debt financing includes the bank loan, which we discussed extensively in the previous session, as well as the non-convertible debentures which can be issued by the company, and also lease financing and factoring, which can also become a fantastic financing mechanism for some of the MSMEs who are generating cash flows on a very regular basis. Also, we see a very good traction and a progress towards receivable based financing, wherein receivables are given as or transferred as an asset, or assigned to an NBFC or any other financing institution, okay, for towards an immediate cash payment at discount. This is a fantastic tool which has come to light of late, and many of the MSMEs are really benefiting benefiting from this. So receivable based financing works in a fashion that, okay, if a MSME has gotten a contract from many of their customers, they can actually assign the entire receivable, okay, of that particular contract, which is supposed to be generated in future out of the execution of the contract, to an NBFC or any other financing institution for an upfront payment of cash, or a loan. It may not be treated as loan, but it may be treated as upfront payment of cash for future receivables at discount, and then the receivables are escrowed and directly paid to the banks as and when accrued. The most prominent financing avenues for MSMEs would become friends, family, and the promoters themselves, who can put in equity and convertible preference shares. More specifically, bank financing. There are many venture capital and private equity funds also now financing MSMEs in at least the growth sectors and sunrise sectors. Strategic investors also play an important role in providing equity financing and debt financing, in relation to bridge finance. HNIs and IPO is also taking a big shape. Recently, we saw two big IPOs being launched with a stellar market subscription once they launched. Subsidies, concessions, and tax holidays and rebates from various government authorities and state government bodies as well could lead to a good financing avenue for MSMEs. These are foreign avenues, may not be much relevant to the audience at large, but just gives a brief of the financing options which are available from the foreign sources herein. If we just go to the key considerations in terms of what financing works at a particular point in time, if an MSME is looking at if the promoters are looking at diluting their stake, or looking at selling out the equity to some other strategic partner or any other investor, then probably equity financing could be a very, very healthy source of financing for growth purposes, because you don't have a regular cash payout as in the case of debt. Equity comes at a cost, the dilution of the stake, but the benefits of equity in terms of growth and expansion, if the business plan and the product is very strong, okay, would give stellar returns to the and wealth creation mechanism to the promoters itself. If there are valuation mismatches at a particular point in time when the investor is proposing to invest in the company, and there are valuation mismatches between the promoter and the investor, then possibly a compulsorily convertible instrument in terms of preference shares could also be utilized, wherein though they are preference shares at present, okay, they can be converted at a particular valuation which both the promoter and the investor agrees at a later point in time based on the performance of the company, milestones to be achieved, etc. So CCPS plays the role of an equity, but a preferred stock till the time the valuation is aligned between the promoter and the investor. Dividends are again a source of financing for the companies, wherein wherein though the loan will have a dividend payout, the loans will have an interest payout over a period of time, but the equity will have dividend payments, payouts from the company. However, here one thing needs to be very categorically understood, that uh, uh, interest payments on loans, okay, will lead to tax deductibility in the hands of the company, okay, at the at the company level. However, dividend payments is treated as appropriation from the profits and would not be available for tax deductibility. However, dividends are not compulsory. That is also something which is to be known. It is only if the company makes profits and the company really wants to shell out money to their investor, to their shareholders, and reward them for taking the risk in the business, then only the dividends is required to be paid. Otherwise, dividends can be withheld for the first year. Redemption premium is applicable to an instrument like RPS, which is a redeemable preference share. So would just like to give you a brief on how the RPS works. Is if a particular if a particular company does not want to dilute its equity, okay, and also does not want to take the burden of the debt, okay, they can really look at an instrument like a redeemable preference share, wherein though the investors will have a preferred stock in the company, okay, at a regular dividend, but the main chunk, the real returns will be generated by the investors by way of a redemption premium whenever those RPS would be redeemed. The cost of the RPS would be lower than the debt, because RPS would give the investors a capital gain outcome, okay, in their hands, which will reduce the tax implications in their hands. So this could be a good tool for MSMEs to really negotiate with the investors in terms of a debt versus an RPS model, wherein RPS gives the MSMEs benefit of uh, a low cost funding, as well as the investors are benefited in terms of a low tax regime in terms of capital gains vis-a-vis a business income, which is in the case of a debt instrument if issued to a particular investor. Tax deductibility would be very high for a compulsorily convertible debenture, because the coupon payments would be deductible at the end at the company level, as well as the debt and the interest payments on the NCDs and the loans which are taken by the company would also be tax deductible. Lease financing model would also, the operating lease would completely be tax deductible in the hands of the company. Ease of repatriation, obviously, in the hands in terms of RPS would much be better, and the debt and the operating lease model would much be better. Depreciation on capex will also be available. So once the funding happens and the investments are made, the capex expenditure is made by the company, okay, those depreciation is also available at the company level. In case of debt instruments like the CCDs or the NCDs, the interest portion which is capitalized, okay, would also be available, would also be eligible for depreciation going forward basis once the asset is put to use. Listing mechanism would also be a very good source of funding and an exit for the promoters. However, listing would only be possible for equity shares. There's listing possible for RPS and debentures, but subject to certain conditions and regulations which are applicable to them. In terms of foreign investment by way of these instruments, equity would fall under FDI, the CCPS and CCDs would fall under FDI. RPS would fall under an ECB regime, which is a very stringent regime, and the NCDs would also fall under the ECB regime as such. But however, FPI route is also available for large MSMEs to tap in terms of financing option. I would also like to discuss in detail the benefits of SME listing, okay, and the wealth creation for the promoters at this stage, because we are talking about financing option, and I certainly believe that once a company, once an MSME or SME is listed, the debt financing options, the credit ratings, the credit gradings, which we just discussed in the earlier session, okay, really turns around in the favor of the promoters as well as the company, because there's a clear value creation and value discovery at the stock exchange level for the company, because the company is a state company, has to follow certain governance standards which are laid down by SEBI and other regulators, and which goes into enhancing the goodwill and the brand image of the company on an overall basis. For investors who are investing in the MSME, certainly there would be tax efficiencies, because the listed shares are taxed at a low rate of 10% vis-a-vis unlisted shares, which are taxed at 20% on long-term basis. Also, it will be much better and efficient for an MSME to create incentive plans for its employees if it is listed, and there is a automatic price discovery and value creation for the employees on the stock exchange as such. So just to go through some of the aspects of MSME listing. MSME listing is a pretty simple process, in the sense that any company which has a post issue paid up face value capital of less than 25 crores can be listed. There are certain other conditions that for NSE listing, that the company has to have a positive net worth, and in case of a BSE listing, the net tangible asset has to be 1.5 times the entire balance sheet size. The biggest advantage for an SME exchange listing is that it has to be 100% underwritten, and the market maker itself has to write it to the extent of 15%. And market making is compulsory for the period of 3 years, which gives enough liquidity to the shareholders or the public at large who are wanting to subscribe to the particular scrip at the IPO level. IPO would also allow the promoters to shell off some equity, okay, and create certain wealth for themselves, as well as have a very at the same time retaining control of the company for future value creation and wealth creation for the company as well as themselves. A delisting process for the company, though not envisaged once the company is listed, but it's quite relaxed vis-a-vis the comparison to the main board. The issue expenses and the listing fees for MSMEs is also substantially lower than the main board listing process. Track record for we already discussed, and offer document vetting is not by SEBI but by the exchange itself, which becomes a much smoother and a cleaner process in that sense. This is the entire listing process, which takes around 15 weeks for an MSME to be listed. The biggest one of this is obviously the peer review due diligence at the initial stage before filing the DRHP with the income tax with the regulatory authorities, because that is the most important due diligence and the vetting process which would comfort stock exchanges and SEBI for a company to be listed overseas. Any questions, any thoughts here? I'll be happy to answer those questions and exchange views on this particular topic which I just gave out. Thanks a lot.
Yes, Mr. Asher.
Yeah, so over to you.
Yeah, thank you. No, I think it was a good presentation, and the importance of SME listing cannot be overemphasized. And in fact, a large number of MSMEs which are on the higher end of the spectrum, probably they have not yet realized the benefits of SME listing. Yes, and I have been urging upon them. In fact, I think number could be as much as maybe 10,000s. And you can imagine what is the number which has been listed. I think as per my last information, it is about 400 companies which had got listed on SME, BSE exchange as well as NSE exchange. I think Mr. Jain may be aware about this. How much is the exact number? I think it could be 450 or maybe maximum within 500.
You're right, sir. It is ranging on the similar lines.
Yeah. So I would say that I think, Mr. Asher, what you mentioned is very relevant. And the benefits of listing with regard to the valuation of the companies in the SME space, which have been sitting there over their business enterprises for the last 20, 30, 40, 50 years. And in the turnover range of somewhere around 100 crore to 1000 crore. Naturally, they are the ones, in fact, who are eligible for listing. I remember companies which are still having 50 crore, 60 crore turnover and have listed and have gained a lot of benefits. But companies more than 100 crore, 150, 200 crore, now of course 250 crore is the definition for SMEs. So they are yet to list and they are not very comfortable with regard to their dilution of the ownership. So we have requested the government that besides the sentimental part, there is an expenditure part also involved. In fact, in organizing the listing business, because the merchant banker engagement and valuation exercise and all these things involve expenditure. So I don't know, Mr. Asher, if you have any idea as to how SMEs can go for listing exercise, starting the listing exercise without spending too much of money in the beginning itself. Can you please highlight something?
Well, so the way to look at it is whenever a particular MSME is wanting to chalk a path of getting into a very regulated environment like a listing environment, there will be certain cost which will certainly be associated with it. Uh, uh, be it the internal, be it getting the internal house in order, following the governance standards to the core, having robust compliance mechanisms for either pre-listing and post-listing. Okay, having the best of the auditors and the advisors in place. Okay, to have themselves to give the public the comfort that okay, their financials are really robust and internal control mechanisms are really working at the level of satisfaction to either the regulators and the public at large. But all these things do entail cost, but it gives immense benefit in the long run to the entire business and the brand and even the promoters, so to say. So I would not really treat these as sunk cost for the promoters or the businesses as such, but certainly something in the lines of the investment towards creating more wealth and business for the entire ecosystem where they are operating. So it's
Yeah, please carry on.
so it is for the promoters to realize that okay, there is certain cost involved, and they should only uh, not they should treat it as an investment rather than as a cost of listing, because beyond the point I would not envisage that really the government would be in a position to do a lot of things. The government can only help in reforming the listing laws in terms of dilution, etc. But the cost involved would certainly be something which will be borne by the company initially. And given the intermediaries involved, given the entire ecosystem of advisors required for making an MSME ready for listing, it's in itself a major exercise which we have seen, because many of the MSMEs are run at a promoter level, entrepreneur level, and are not robust in terms of compliances and internal controls when they are growing, and it requires an effort to get there, okay, to be able to get listed. uh, and there comes the cost. uh, and also if you have a long term view of the entire situation after listing for the entire business as a whole, okay, it will generate just benefit for everyone, including the promoters, the employees, the business as a whole, and the entire ecosystem. So yeah, that is my view. Beyond the point, you cannot really reduce the cost. And, the SME platforms itself have a very relaxed mechanism in terms of listing, etc. but certain checks and balances in terms of the due diligence process, the merchant bankers, underwriters are all for the benefit of the for the MSMEs to get listed and to extract the value which they really deserve.
Yeah, no, let me go back to Mr. Jain now. In fact, Mr. Jain, can you guide the SMEs as to what are the parameters or the benchmarks which any SME, whether it is micro, small, or medium, can check on to see as to what kind of rating they can command. What I am saying is, I hope you understand that before going outside, how they can check their own rating by applying certain parameters and benchmarks, and what are those benchmarks or parameters which they should look at.
Sir, I mean, as you are aware, I mean, credit ratings are not systemic driven. We don't follow any systemic driven approach. You are aware about it. So rating is very, very subjective in nature. Every single assignment, what it comes to any rating agency, I mean, is different. It is different in nature. When we rate any organization, methodology may remain same, but the outcome will differ due to the nature of the operations what any MSME is adopting, or the processes or the good practices, the good corporate governance what they have adopted, the kind of numbers what they are commanding on, what kind of clients they are catering to, what kind of suppliers they have on board, who are their investors. So all this forms an ecosystem for any MSME assessment. Again, I mean, to be a little specific to your answer, I mean, generally, a couple of things. I mean, the quantitative parameters in which you have already spoken, the key ratios, I mean, liquidity, debt equity, current ratio, quick ratios, these are the important ratios, the gearing. These are the important ratio what any, MSMEs should keep in mind when they are, assessing themselves on a quantitative parameter. Again, scale becomes very, very important, how they are growing year on year. That is also, is seen by any of the rating agency. We also see what kind of market they are operating to, what is the geography they are covering. Is there any scope for further growth? What kind of capex plan are on the planning stage? Who are the people associated? I mean, the key managerial. Is it as Mr. Usher has just mentioned? I mean, most of the MSMEs are driven by the promoters. They are promoters driven companies. So how empowered the other employees are within the system, that is also very, very important for any of the company's growth. On the qualitative side, again, I mean, we see the key managerial positions, the education. I mean, these are the key things when any of the rating agencies, when they do their assessment for any of the ratings of the corporate, these are the important factors which we generally keep in mind.
Right. No, I think it is very useful. Before spending money, in fact, we thought that let me have some inputs for the benefit of the micro, small, and medium enterprises so that they can assess themselves as to what is their financial condition and whether they meet with some of the expectations normally which rating agency, rating organizations give and the banks accept. So I think it's very useful what you mentioned.
I mean, in fact, I mean, post the rating also, when we complete any of the rating assignment, we get into the dialogue with, any MSME or any client, any corporate, and we also guide them what are the factors which has resulted in the rating outcome, whatever we offer it to any of the clients, and what are the scope of improvement. I mean, what are the parameters which they should work on in the next 8 to 12 months, so that they can improve on their rating next year when they will come for the surveillance. So this also helps them for any of the client to improve when they come with the new numbers, new information next year. So it builds on it.
So Mr. Asher, would you like to add something?
So this is this goes on to say, at least from what Mr. Jain discussed, is once a particular MSME looks at listing, okay, they will really have to upgrade their the internal governance control and the in-house processes, etc., to be really able to list themselves. And it works in favor of them, okay, once they get listed and go for any credit ratings for availing loans, etc. Just to conclude, a listed enterprise versus an unlisted enterprise, the listed enterprise would be much in favor in terms of the getting a better credit rating or the credit grading outcome, okay, and would have more chances of getting a favorable terms from any banks or NBFCs or any financial institutions which they are planning to tie up.
Right.
It's a circle which needs to get completed. Promoters really need to look at professionalizing their setup and institutionalizing their organization to that extent.
Right. So I think we come to the close of this discussion and the presentations. I would urge Mr. Zumair and Sodamini, in case there are any questions, we can take up the question answers.
Yes, sir. There are a few comments, observations, and few questions this time from the audience. Mr. Shekhar Chaudhary, he has a comment that the rating agency gave a report just by asking few simple questions without any due diligence. So that has been his experience.
Okay. So, I mean, I mean, valid point, I mean, I must say, and I'd be happy to answer it. So I would brief you on the process. I mean, any business team, I mean, the first thing is once we get the mandate at CARE, uh, the moment we get the mandate, the analytical team is assigned. So there is a two separate verticals which work, for one particular assignment. One is the business vertical, which is the relationship vertical, and another one is the operations vertical, which is precisely the analytical team who conducts the rating exercise. So the moment the mandate is given along with the basic information like financial CMA data, sanction letter, KYC information like PAN, TAN, GST, etc. Once it is there with us, the analytical team is being assigned. Once the analyst is assigned, they get into the dialogue on a day-to-day basis. And say around a week, 10 days of time, I mean, the basic note is being prepared based on the operational information and the financial information, what the client is providing it to us. And post that, we go for a site visit compulsory for conducting the rating. No rating in the committee goes without having the management discussion and site visit at a client's place. During COVID time, of course, in the last 2 years, we had a limitation where we were not able to travel out to meet our clients. But at that point of time, we were having the virtual, discussion which took place before assignment of, the ratings. So, I mean, the point, what it is mentioned that we don't do any due diligence. So no rating outcome is a reflection of mere the information submitted by the client. Rather, we talk to your chartered accountant, we talk to your banker before concluding the rating, before concluding the rating and going to the committee. The bankers' feedback, bankers' due diligence is mandatory as a part of rating exercise. Every single rating will have the bankers' feedback. Every single rating will have a chartered accountant feedback. And, as the restrictions are eased out now, so we will again be venturing out and meeting all our clients. So we don't just sit at office and try to come out with a rating conclusion. So, I mean, I differ on this.
So, any other question?
Yes, there's a question which is asking that there are companies which are not yet at break even, and they are in the trajectory of turning around. So no ratios will be healthy for them. So what are the funding opportunities for such companies?
So, Mr. Ashar, would you like to take it?
Yeah, if no ratios are healthy, then certainly it would be difficult for such a organization to go to a bank or an NBFC for funding requirements. However, such entities can look at venture capital financing, uh, uh, wherein not the ratios, but the business model, the strength of the product, and the growth prospects are more important for venture capitalists to invest. Uh, that and they would also be in a position to take a much higher risk than banks and NBFCs at large. Also, there is a product of venture debt available, which is a last mile funding, which is provided by many venture capital organizations. Say if a particular MSME is stuck with the last mile funding for a particular large contract which they really want to execute, then probably that could also be a one more mechanism open for such situations. Um, in addition to that, there could be certain NBFCs who may be in a position to look favorably certain customers which do not have healthy ratios but have healthy cash flows, and projections in place, and obviously the business model and the product would also play a role, but they are few and far between as such, at least in the industry today. uh, in addition to these, the friends, family would initially help, but yeah, venture financing is something which such companies should really look at tapping for themselves.
Thank you. Thank you. Any other question, Sumer?
No, sir, that was it for today. And now over to you for vote of thanks, sir.
So I think we have had wonderful discussion on this very important subject. I think some of the problems of misunderstanding by the micro, small and medium enterprises in presenting their financial position, and also projections to the financing institutions, banks particularly, would have been addressed. And I'm sure that the MSMEs would be able to restructure their financial condition accordingly, and look at from their own side as to what is the internal rating that they command by way of working out those tools and financial ratios which we discussed. I think our distinguished speakers, Mr. Jain and Mr. Asher's telephone numbers and contact details are available with Power to SME. And if you really want to contact them, please do so. And in case you have any other question for Power to SME or any of these institutions, you can write to Power to SME. So with that, I hand over to Mr. Zumair for closing. Thank you.
Thank you, Dr. Kumar. Thank you, Mr. Jain, Mr. Asher, for taking out your valuable time and having this insightful discussion. I hope all the participants must have gained the much needed knowledge out of it. And I thank all the participants again for joining us. And till we come up with our next webinar on some more attractive topic around MSMEs, we will meet next time. Thank you.
Thank you, Mr. Jain. Thank you, Mr. Archer.
Thank you, sir. It was pleasure connecting with you. Thank you, Zumair, for arranging this. Thank you, everyone.